Welcome to the Perspectives on IBC series, where advisor Chris Tormey joins me in a discussion on all things related to the infinite banking concept. In this educational series, you'll learn the basics of IBC and how you can recapture the financing function in your life so you can gain more control and freedom of your wealth. So welcome, Perennial Pride listeners. So we are now on episode 9. Unbelievable, with the foundations of IBC, the infinite banking concept. I'm here with my good friend, Chris Tormey. Thanks for joining me today.
Thank you.
Always good to have a partner in crime here to talk through this and get different perspectives. So in the prior episode, we talked about how IBC can really be a huge asset and tool that business owners can use in a whole host of ways. And a lot of it, we focus on things like cash flow management. And for how we're going to sort of focus our attention this episode is around people who are not business owners, right? This is for personal use. And you'll notice if you listen to the other one on business owners, there's certainly going to be some parallels, because obviously the tool itself and the process, it's centered around more efficient cash flow management, and business or in personal lives, we all have that need, right? But how we're gonna approach it from this episode is kind of take it into phases, and we recognize people are going to be coming into IBC potentially at different stages in their life, different sort of backgrounds, etc. But we're going to try to paint sort of a broad sort of picture of how you're building this into your life, and then how you're using IBC throughout life, and even sort of the wealth transfer. So, Chris, let's start with just the building phase, because I think as we're thinking about this is a long-term strategy. We know we need to think long-term, but starting off and building this sort of IBC business, if you will, a banking business. Like, share some of your thoughts on what people need to be thinking about, how they can actually start using this in the early stages.
Sure. Thanks so much, Tom. Yeah, the way I look at it is, your first policy is the one that you're most typically nervous and concerned about in terms of stepping into a new environment, one that you haven't experienced before by definition. The two ways I've helped coach clients into their first policy, one would be, let's set something up with a tremendous sort of amount of cash as percent of death benefit, but under the MEC limit, and then have term life insurance right next to it to make sure to hedge against the catastrophic situation, and also have a way to move more death benefit into the whole life policy. So that's number one. And so that first container tends to be a smaller container, and one that illustrates well and should perform well in addition. The second way to go with people who are really wanting to experience something that starts out big and has an investment, like you said, of that long-term view, is to build something that's definitely going to be a shortfall in cash value, really in the first handful, or maybe even 6 or 7 years. But now it's a large container that they have a lot of flexibility to add additional paid up addition, is what we call it. But it's basically premiums that you could wait 20 years to pay, but you can upfront pay them. You've got enough death benefit and the right contract that you can push that money into the policy when you get certain windfalls, whether it be a bonus or a liquidity event of some sort, or a big year in whatever you do particularly. So those are the two ways I see the beginnings, and the way we build upon those are going to be two different ways. One is, hey, we're full already on this one, but you like the feeling, you like what it's building for you, let's convert more term. And the second one is, we've got a container here that's large. If we want to add a lot of extra premium early, we've got it there to do it. So those are the two ways I see setting up a policy for a client. And we go both ways depending on what the view is. The first way illustrates best. So as much as we say this is not an investment, this is a place to store your cash, far and away better than a checking account. The eye is trained to look at those returns sometimes and see what the cash value is doing in the illustration, and then should be reflected by the actual performance over time. So sometimes that small container, large cash amount to the limit really is a first way to go for people who haven't been looking at this for a while and seeing the potential. And that's the other thing I'd say before I throw it back to you is it's just amazing how like the first policy can be so nerve-wracking, but then 3 years, 4 years later, the excitement, the interest in building more policies for my client, and a lot of times for their spouse, their kids, their relationships, their partners if they are business. Although today we're talking about personal policies, that starts to grow because they see the potential. It's not until you actually do something you really get a feel for what it is.
Yeah, no, absolutely. I think you're right. That experience that comes with it and seeing it sort of develop over time, I think, yeah, certainly for clients I've worked with, it starts solidifying their understanding and belief in it, and they actually see it happening. And there's nothing that can replicate experience, I think, in a lot of ways. So yeah, I totally agree with you. And yeah, and this is the phase, to your point, just like anything else that's kind of new or potentially unfamiliar, it's a little scary. And getting something started, I think, is key, especially recognizing that you may grow into other policies and build on this. This isn't the only policy likely you'll have if you truly understand and grasp the whole IBC strategy. But this is a starting point. And, this is where, Chris, I always stress for folks that some people, once they understand it, want to just jump in and go into it. But sometimes their cash flow sort of situations don't allow it. And you're going to have to kind of sort of move into it a little bit and get comfortable and get the right habits in place too, to make sure you have cash flow to fund these things, because it's going to take a little time. You're going to be behind a little bit early on in some of these, even at the optimally designed policies. It's going to be a little bit behind versus maybe your checking account. So some of your liquidity is not there. So you just need to understand that the short run pain for long-term gain in this, and be comfortable with that going into this sort of strategy and product.
Yes. And it's a partnership. There is a partnership here between you and the insurance company. And that's why we do a lot of vetting. And I like more than a handful of typically the mutual life insurance companies. Your cash is completely accessible and so easily, flexibly used. But the growth of that cash is linked to the performance of that general account. And we do a lot of due diligence, you and I, and with each other and also for our clients. But there's no hard, fast rule to stick with one company. I know people who have policies with different companies as sort of a portfolio of insurers. It's a little tougher because you do have to take a new physical. You can't just convert an existing term policy. Well, there are ways that happens, but it is a partnership you're jumping into, and a great one that's been around for other policyholders, for generations, even more. But it is it is a step in a building sort of relationship with another institution.
Yeah, and that's why you have to. We focus on some of the bigger and stronger ones that have that track record, been around for over 100 years, right, and paying dividends. So we definitely recognize that's part of the risk of getting into something like this. So the good thing is that if you're designed right, and this is why you work with somebody who's an IBC practitioner, designed right for your situation, right? It's all personal. That it builds up cash faster than a typically designed policy, right? So that's a good thing. And depending on the level of your contributions to it, to the certainly the PUA side of things, the kind of more short run savings is how I position it. That in a not so distant future, say 3-4 years, every dollar you put into these accounts, your cash will grow by more than that, right? So it just takes a little bit of time of that early sort of contributions to kind of get this thing moving along and starting to gain a little bit more efficiency. So Chris, and this is where people who are especially say real estate investors are looking to get money out quickly in this, share with the audience sort of kind of some philosophies on using it early versus kind of letting it build up, which you're sort of
Sure. Yeah, I think for anyone, business owner or real estate type investor, really anyone, you've got to have a cash cushion for those things that are unanticipated, either opportunities or emergencies looking forward. So this idea, which we do see around the YouTube universe and so forth, of immediately taking all the cash, well, then the question in my mind is, well, where's your cash then? Because to have 9 months to a year, to depending on what you do for a living, bonuses and the frequency of pay and so forth, and the stability of pay, having a year to 2 years of cash is not a bad thing. In fact, we think it's a very, very good thing. So to immediately grab the cash to invest begs the question, where's the cash? So I'm a big advocate of letting these things grow and being a little bit more prudent, waiting for those real great opportunities. Now, a lot of times we'll have people that they've got the great opportunity and they want to flow their cash right now through a policy in order to exploit that opportunity. Sometimes it's better to just go after that opportunity with your cash balance, sometimes with whatever you have in checking or what have you. But to build up something for the long term, that long vision, it makes sense to really wait that 2 to 4 years before, unless the opportunity is really profound, before you're regularly accessing it and using that cash. You've got to essentially have more cash than that 1 to 2 years, or let's say that 9 months to 15 months of cash availability, to then get it into investments, right? It's rare you want to be 100% invested, 0% because cash, because you don't know, it could be the investments themselves that get into trouble, but it could also be you yourself that gets into trouble. And without any cash or liquidity, that's not a good place to be. And the other thing is regarding when in your own life. And we talked about this a little bit before we started recording today. We've worked with people for their children who are 1 year old, for young adults who are in their mid-20s. The healthier, the better. The younger, the better, but more fractionally. What I mean by that is someone who starts a policy in top health will illustrate, let's say, a 5% kind of return looking out 10 years. Someone who's 60 and starts a policy in top health, their top end cash flow growth is going to be in the high 3s. So a difference of, let's say, 1.25%, 1.5% per year. But of course, that's because the pool is going to have a lot less deaths starting at age 25 versus starting at age 60. So the death benefit aspect of it comes more into play, not for the individual. That's never why we're planning this. They couldn't get insurance if the death benefit was something that was quote unquote in play, but it definitely sits in your pool more likely. It's just the sad reality of getting older.
Yeah. So and this is, and everyone will ask this question around, internal returns within a policy, and to your point, they're going to vary, and there's a lot of factors into that. And we just want to emphasize that's one piece of this whole puzzle. I mean, the entire strategy itself is bigger than that, right? This is if you're believing in the sort of thought around taking over the banking function of your life, right? This is a different animal than trying to eke out an extra rate of return or a percentage point. This is a bigger sort of sea change and mindset change. So don't want to just ignore it, but I just for those who are looking to take this sort of on for their entire lives and maybe impact generations, it's not just about rates of return. And so when we think about after we're building this up, this banking function as you get it humming along a little bit over years of contributing to it. Just like a business, you're capitalizing a little business. You're like in a banking business. And so now it's starting to sort of get a little bit more efficient. It's, you have some funds in there. So let's shift into this kind of what I would consider kind of a second wave. Like now you're actually maybe actively using and leveraging your policies to do banking, right, for a host of reasons. So let's talk a little bit about that, Chris, and how folks can use that for their personal lives.
Yeah, I'd say for 99% of the time, while you're in your career life and you're setting up these potential real estate or business opportunities around that, again, we're talking to the people who have a regular W-2 or a very solid skill set that they get regular 1099 income. While they're in that growth stage, typically 99% of the time, we want to utilize the loan. Usually the loan from the insurance company itself, because it's just so easy. You're dealing with a one-pager, or even some of the insurers have done a wonderful job with their websites where you can move money via loan into your bank account on really a 1 day's notice. They'll warn this will take 2 to 5 days, but my experience has been 1 to 2 days. And then you can pay it back anytime with no forewarning. Just pay it back when you want to. I think the only time during the course of your career that you want to be pulling the basis, which is the tax-free portion of what you can withdraw, not through a loan, but actually withdraw, is when you've built a container that's too large. For some reason, the plans you've made for your overall wealth, your overall income growth, the trajectory that you thought you'd be on when you opened this policy or these policies is for some reason flatter or downward. And therefore the policy is just the container is too big to fit the wealth that you currently are on a trajectory to make. Or sometimes it's you're already pulling because you're unemployed for a year, 2 years, 3 years, and something's wrong. And in those cases, we certainly don't want the insurance policy to be your entire wealth picture. So withdrawals, again, in very small percentage of the people we work with, but this can happen for sure. And so then a withdrawal perhaps is appropriate in your 20s, 30s, 40s, 50s, 60s. Now, when you're older, as you and I talked about, that's a whole different story that you probably want to jump into now.
Yeah, well, hold on that for a second, because I think what you're describing is a key point. Like, especially as you're building up your IBC foundation and certainly maybe your initial policies, is if you're going to leverage those dollars to and borrow against that asset, right, and borrow from the life insurance company. So you're not using your own money. You hear some of that stuff being sort of misstated. You're not borrowing your own money. You're borrowing someone else's money, the life insurance company's money. And you should, if you're borrowing it, just like any other institution you borrow from, you're responsible to pay it back and do it responsibly and set up your own payment schedule. Yes, the beauty of these sorts of guaranteed financing sources is you have more control. So you don't have to pay it, but it is highly recommended to get on a rhythm to pay it back as if it was a bank, right? It's your bank that you can control, right? You should pay that back, especially as you're building this asset up. There might be some cases that you would draw early, but to Chris's point, it should be rare. So it's got to be kind of get into a rhythm of true financing, right? It's just a different institution. So as you're doing that, to make down payments on real estate property, invest in your business, even to fund college, right? This is any source of financing you need to kind of support your life in any way. This can be used, but you just got to make sure that you're mindful of the repayment schedule and trying to stay on top of it, because it is your banking environment and it's part of the responsibility of getting into something like this.
Yeah. And I'd say, the word is balance. You need to be balanced. And I've seen much more often a problem with imbalance of having too much in traditional IRA 401k, and the wealth picture has changed downward. And now the pull from a 401k or IRA is going to be either a loan if it's a 401k, but more often when the wealth picture is turning down, you don't have an employer anymore. There's no loan available to the 401k anymore. So the IRA, and now we're talking about IRS related scheduling and sometimes penalties and so forth and so on. The insurance policy doesn't have any of that. So it can afford to be larger and workable, sometimes over 2 or 3 or 4 years, if that's the period that it takes to turn that wealth curve back upward again. But the question is balance. You want to have we talk about a tax triangle or a risk triangle where you've got a certain portion in that traditional retirement, a certain portion of investments that you have, either liquid or illiquid, producing a yield. And then you've got a certain portion of this cash waiting to get into the markets to do good things for you. If you've got balance between the three, and that's what we work with our clients on all the time, that's when we have the most flexibility looking forward and to be able to draw the proper way, which typically is a loan, typically is a borrow from the insurance company.
Yeah, no, that's it. And the good part about loans, and I know maybe people have reservations around taking on debt, and you have to be smart about it, right? Because depending on where you're utilizing these dollars, right? If it's for an investment, and knowing what you're investing in is key, right? You are taking a loan here. And so with the expectation it will be paid back, now granted, we'll get into that a little bit later, that could be paid back when you kind of graduate from this earth. But for the meantime, as you're building up wealth, paying this back and freeing up more capital to be able to use for other investments or purposes in life. And the beauty of it, as you know, these policies are getting more mature, the dollars you contribute, it's increasing your cash value by more than you put in. So it's really starting to get, efficient around this sort of stage where you've maybe capitalized it for maybe 5-10 years, maybe roughly, and really starts humming along quite well. And it's a really good place to store wealth, like we've kind of stated at the beginning of this. So you're going to start really seeing that and starting to, and you might at this stage start adding policies, right? Because if your income and sort of life has gotten to a point, right? Hopefully things are better. You have more income coming in. You've other investments that are bringing you income, which we hope Chris and I are big advocates of that, like buying assets that bring income now, and then you can funnel this back to your banking environment. But you might run out of room, right? And this is where you start other ones and create more to add to your banking sort of system. And so that'll come in due time. That's just kind of typically when it's going to happen.
Yeah, two quick things on that. And we did talk about this in an earlier conversation. I like a plan A strategy to pay back your policy loan, and a plan B strategy, and sometimes even a plan C. So plan A is whatever the opportunity, the investment is, that's what's going to pay back that policy. So the initial profitability and cash flow goes right back into that policy to cover the, after the whatever else you have to pay, labor or taxes or what have you. But the rest goes into that policy. You don't adjust lifestyle until that policy loan is paid back. Plan B, if the opportunity doesn't work well, or if it's something like a college education that you're not asking your child to pay back, it's on you, then you're going right to plan B, which is you just have to work harder in your regular job and spend less in your regular lifestyle to pay back what you've borrowed. And plan C is if you get sick or injured, you really want to have in that contract the insurance company paying the premiums if you're unable to execute on plan A or plan B. So that's extremely important, I think, to make sure you're aware that if plan A doesn't work out, you're still responsible to pay that loan back. And it makes sense to have that set up prior. And we spend a lot of time working with our clients on that.
Yeah, no, absolutely. And it's good. And I like the way you position it. That's the power of this, is the flexibility, right? Things will change and we can lay out the best plans, but they will shift. And so, and life happens, whether we like it or not, for good and bad. And so this is why I think this is attractive for many who want a little bit more freedom control of dollars like this because they can flex and pivot as needed and give them a little bit of breathing room.
And when you mentioned buying another policy, which we're all for as your wealth curve deems it appropriate, I am not an advocate. I'd love you to talk about it too. I'm not an advocate of using cash value in policy one to buy a next policy. That is not, in my mind, an opportunity. That really should be fed, that second policy, entirely or for the most part from cash wealth sources outside of the first policy. That daisy chaining of policies I have seen again in the YouTube world, that I personally am not going to speak out against it to social media, but I definitely don't incorporate that into the strategies that I do.
Yeah, no, I'm completely on board exactly with that. And this is where you evaluate your cash flow and hopefully have means to increase it, right? Through investments, through your work or other means. And then be positioned to maybe add to your banking sort of system to accommodate that. So great stuff. So let me shift gears. I know just to give you a flavor of it. Obviously, for most people, and I don't think we're as big proponents of the concept, but people eventually retire, right? Everyone's shooting for retirement. That's the target. I actually prefer to not use that term, but transition, if you will, to something else. But you might be, maybe shifting away from a job you had, or maybe selling a business, or whatever the situation is. But you're sort of transitioning into something a little bit more of a, I guess we call it a decumulation. We've accumulated a lot of wealth. Now we're going to try to use that to sort of support our next phase of life. And so what do you see are the major things to consider as you kind of transition into that?
Well, I mean, the first thing is to have enough assets and enough contracts in place. Most everyone outside perhaps some government employees have a Social Security lifetime cash flow that can start as early as age 62, if we're talking to Americans here, as late as age 70. Then what other cash flow sources do you have? We spend a lifetime with our clients building up those things like real estate and other types of yieldy, higher cash inflow type businesses. There's annuities to buy, things like that. If you want to supplement that monthly cash flow, sometimes we call it mailbox money, even more. But then the assets themselves have to be built up to a certain position that really, working with a financial advisor, you feel very comfortable that everything's in place to not have to dedicate to whatever your skill set was, engineer, doctor, dentist, you name it, and you're just tired of working in that particular skill set. Or maybe your hands just aren't where they used to be or where you're comfortable having them. Or you've lost interest after 30 or 40 years doing whatever it is you were doing. And now you can do these other things, this portfolio of assets that you've perhaps accumulated over time. But in that new era, there's two huge uses of the whole life policy. One is there's going to be years in which all assets drop in value, or most assets drop in value. And you want to still be able to access cash for your bucket list, or for maybe the topping off the lifestyle, for your gifting strategies, things like that. And having that big cash access to that basis that you built up over the years is certainly a way to pull money now in your 60s to service lifestyle while you don't want to sell assets that are down. And the second one is, which is somewhat distinct from the first, but we do work with clients where we'll do both over the course of their lives, is to just turn that policy into some sort of annuity-like pull. So that becomes, it's not an annuity in that if you live to 120 or 130, it might run out of cash before you run out of life, whereas annuity has a specific promise to last forever, as does Social Security. But for reasonable lifespans, we gauge, a certain X dollars per month, $5,000 per month should last you to 95 or something like that. And so it just becomes kind of a regular source of mailbox money. And for that, we do access the basis tax-free first strategically, unless it's a really huge drop in the market where we might incorporate a loan, believing that our other assets will head higher in future years and we can pay back a portion of our life insurance policy. So tons of flexibility, depends on the client, depends on the market environment, depends on taxes, for example. But certainly we're going to work with folks who've stopped their main job, let's say, 60 and up, could be 50 and up, and look at a loan versus a pull of the basis, and even sometimes a pull of the gains. Sometimes a pull of the gains, if you're in the right tax area, lower tax area, you can pull the gains and pay income tax on that. So we always make sure to say tax advantaged access to the cash, because A, the basis can be pulled tax free, which is unlike all other assets that you're typically investing in, and B, it's tax free in death. But if you're not in or in a very deep sickness, chronic or critical illness, but if you're healthy and you need that money and want it permanently, you will pay taxes in whatever tax level you're at.
Yeah, and that's the good part about it. It's pretty flexible, and you could even set up situations where you no longer have to contribute to this anymore, right? Just given your situations, like there's concepts like reduced paid up that you can shrink the policy in a sensible way. You never have to contribute again. So there's tons of flexibility. But to your point, Chris, there's a lot of ways to manage it, the tax sort of angle to it, depending on what else is happening in your life. And that's why this is not the only asset you should have, right? This is a complementary one to a lot of different things, from investments and annuities, whatever the situation. But you can extract a lot of the money out tax-free, and you could even get to leverage some of the gains, or all the gains, or most of them, without tax hits as well, if it makes sense, right, for your situation. So a lot of flexibility there.
And it really puts life insurance in a whole different light from most of the country, sadly. And that is, it's not an income replacement asset. It's a use of cash asset. And it does recognize that death, whether it's catastrophically, tragically happening, at a young age, or in your 80s or 90s when it's more natural, it's still a sad event, and it's an event in which the earth or the family around you have lost something very, very significant. And to have that death benefit to cover the pause, to cover the things that happen around someone passing, either leading up to the passing, if it's a deep sickness, or post passing when it's time to celebrate a life, to have that death benefit. Because when you're in your 40s or 50s, and that's a lot of our clients, and you say, well, as long as my money lasts, then it's fine. When you're in your 70s and 80s, your money and your children and grandchildren's money starts to kind of mix in people's minds. And to have that life policy there, which only emerges at death or in deep sickness, is quite a valuable asset. I mean, just tremendously valuable. And I know this is a series on IBC, which is emphasizing the banking aspect of strategy or concept of a life insurance policy. Ultimately, the death benefit rides above the cash value all the way up into you're 100 years old. So to have that there at the tail end for your loved ones is just such a valuable thing.
Oh, absolutely. And so with that, I'll just shift briefly to talk about the sort of wealth transfer aspect of this. Obviously, this is still life insurance, and life insurance has a lot of benefits to it as just a normal, what people think about this asset. And in episode 7, we talked more about that as it relates to how to help support, the wealth building for future generations. So we won't go into that again. I would urge you to go back and listen to that one. But, certainly as it relates to the banking function, is that if any outstanding loans are still tied to this policy, they will be extinguished by the death benefit when you pass. And then any remaining amount left will go to the next generation. So there's certainly the loan aspect of it needs to be managed and overseen and be disciplined with it. but you can die with a loan outstanding, and it will kind of get handled through the wealth transfer aspect of it. So if you're using that throughout the course of your quote unquote retirement, it still can work, right? And still
Yes.
mitigate any sort of serious tax issues. So we have to be mindful of that.
Yes. I don't think we've used this term, but it is a multifaceted, almost like a Swiss Army knife asset. So we couldn't possibly cover all the things that it can do for you, both in its growth phase as well as in the years where you're going to access it, either young for opportunities or emergencies or older for cash flow. Every circumstance is different, and the flexibility offered, the amount of choices that are in your hands owning this asset really is, I hate to say infinite, but there's a lot of them, awful lot of them.
Yeah, infinite. I wonder where that came from. So yeah. So listen, we've covered quite a bit, and again, this is where if you find through the course of these episodes that this is something that you think might be good for you, you definitely should reach out to an IBC practitioner, Chris or I, or any of the folks who are in the practitioner program would be more than happy to help you see kind of the possibilities around it. And frankly, a lot of this gets into, and Chris, we've talked about this, is just a shifting mindset. We've grown so accustomed that, bankings and banks are such just a normal part of life, from how we, extract money from an ATM to where our paychecks go, et cetera. This does require a little mindset shift to say what are other areas to leverage a banking type function. And this is the tremendous strategy, a process for people who maybe want more control over that. And it just requires the learning through what you've gone through here, and then sort of continuing that on as you start building up your own policies and utilizing it. It does require a little bit of sort of continual education on it, and it's important. I think that's where the huge benefits really come, because then imagine trying to share this not only for your children, but grandchildren, and perpetuate this sort of thinking. It could be hugely powerful. So Chris, any last sort of thoughts from your end and your perspective on IBC and kind of that we haven't covered throughout all of these episodes?
Well, I just say, just to echo what you just said there, this is a new way to think for so many people, and it's a really healthy way to think. It's about abundance, it's about wealth growth, it's about contribution to others. It's going to help family relationships, personal relationships, business partnership relationships. There's so many things around the concept, not the product, that really bring health to your finances, and hopefully, since financial health and physical health are linked in some ways, your physical health as well. So anything we can do to help you learn more about this, I'd be more than happy to share. There's no one who, we didn't even get into this, but there's no one who's not eligible. Even if you're uninsurable, we can do the infinite banking concept with a loved one you have, as long as they have an insurable interest, a partner, a spouse, a child, to extend this infinite banking concept. So everyone with the proper preparation and the proper mindset can become benefited by looking deeper into the infinite banking concept.
Absolutely. Yeah, it definitely, that's a great way to cap off this series. It's called Infinite Banking for a reason. There's endless possibilities of what this can do and help support for your life, and what it could do long run for your family or other causes and things you care about. So thanks for really sticking with us throughout these episodes. Hopefully you found them helpful. Chris, I really enjoyed our time together talking through it, and hopefully we're doing more of these and on different topics, but I really appreciate your insights and sort of participation in this. You really helped sort of bring this to light, so I appreciate it.
Thank you, Tom. I love your show. Love Perennial Pride. You've really been a big influence on my life, and I just thank you for that. It's been a wonderful 9 modules, and I look forward to more.
All right. Take care, and we'll see you back on the Perennial Pride podcast. Thanks for listening to this podcast and hope you're enjoying this series on the infinite banking concept. In addition to the podcast, I would highly encourage you to get the book, Becoming Your Own Banker by R. Nelson Nash. If you want to discuss how IBC can enhance your financial life, feel free to book a free call with our team. We'd be more than happy to help. Visit perennialpride.com to book your call.